In this New Year's video, I want to take a look at where I think we're going this year. I'm going to start off with the stock market. Um, there's nothing here to convince me otherwise. Pretty sure we're in the second stage of a bubble. um, Most bubbles begin with a slingshot move, a very scary corrective move that gets everybody on the wrong side of the boat, and then price takes off to the upside. You can see in this long-term chart, price is just stretching absurdly far above the 200-week moving average. Pretty good sign that we're in the middle phase of a bubble. I've gone over this before. This looks like a T1 pattern to me. So here was the first leg up out of the slingshot, and then we had this multi-week sideways correction that tends to occur in a T1 pattern. That's the halfway consolidation point. Once price exits that consolidation, then the second phase of the move is roughly about the same magnitude as the first. So we had about, just give or take, we have about 6,000 points here from the bottom of the slingshot to the where the consolidation began. We're breaking out of that consolidation. I would say at this point where it's pretty clear that this is a sustained breakout. So my anticipation is another roughly 6,000 points from this breakout. So around 18,000 would be maybe where we want to start looking for a top, maybe even a little before that. Sometimes these T1 patterns, the second leg doesn't quite reach the same magnitude as the first. Very often it'll come up just a little bit short. So I would say once we get to 17,000, you want to start dancing pretty close to the door. And then, as we know, when bubbles pop, they tend to lose anywhere from 70 to 90% of their value. So if we assume that the NASDAQ is going to get, at least somewhere near 18,000, give or take 1,000 or so on either side, and that we just get a normal bubble collapse, we're probably going to we'll definitely come back down, slice through this 200-week moving average. Bear markets do that. They go through and then they turn that 200-week moving average back down. So I'm going to take a guess and say when the bubble pops, we're probably going to come back down and test the 2,000 high, and that was right around, let's just call it 5,000, right around 5,000. So assuming we can make it all the way to 17, 18,000, we're probably going to come back down to at least 5,000 during the ensuing crash. Moving on to the Semiconductor Index, this has been the leading sector. The same thing is happening here. Once we broke out above that 2,000 high, which was at about 1360-ish here, then we get the slingshot move, comes back down to test, and actually overshoots a little bit to the downside, tests this 200-week moving average, then we get the slingshot move back up. Again, I don't expect the semis to top until the NASDAQ does, so we've probably still got quite a lot of upside here, although I think time is becoming limited. I'm expecting a top probably sometime in March or April. And as we get deeper into this bubble, smart money is going to start to become more and more nervous. We're going to get the profit-taking events will become a lot more volatile. It's not going to be out of the question that we could have 10% drops in the NASDAQ in a very short time span. Even during the last bubble, 4 to 6 days, you could get a 10% drop. That's probably going to start here before too long into the new year, January, February for sure. I would say we're going to have at least one or two really scary 10 to 15% corrections before we get our final panic melt up phase and a final bubble top, and then we start that collapse that's going to cost us at least 75, maybe as much as 85, 90% before it's over. It'll usher in a worldwide depression, I'm sure. All right, here's another clue that something is wrong. The banking index is not following the general indexes to new highs. That has occurred before every major intermediate or bull market top. The banks start to sniff out trouble in the economy before the other stocks do, and they usually will not. Um, they'll have a divergence. They won't follow the rest of the market to new highs, and that is definitely occurring. The banks were not able to make a new high into this 2018 top, and then they are lagging badly. So a big warning sign. All right, moving on to commodities. This is oil. Once the bubble in the stock market pops, then, I'm pretty sure we've already started it, but I think we're starting a new long-term bull market in commodities. This is oil. The commodity bull is being led by gold. I'm going to show that next, but oil, the base metals, everything, agriculture especially, is all going to participate. So when stock market bubble pops and the liquidity starts coming out of stocks, it's going to look for someplace else to land, and the place it's going to land on is the undervalued commodity complex. Now, the last bull market in commodities, which began in 2000, it was led by energy and base metals, and then precious metals kind of took off as the second phase of the commodity bull. They tend to unfold in two phases, and what leads during the first phase usually lags a little bit during the second phase. So you can see here, during the commodity bull, the leading sector was energy and base metals as the housing bubble expanded across the globe. Emerging markets, huge demand for energy as emerging markets expanded. And so the bubble, or the first phase of the commodity bull, was led by energy. You can see we had the top right here in 2008, and then the commodity bubble burst, and then we get the second phase of the commodity bull market. But energy and base metals, the leaders during the first half of the commodity bull, started to lag. And let me switch over to gold. And during the second phase, so this was where the energy and the base metal bubble popped. This is where the commodity market topped, and then out of that bottom, the regular commodity markets and energy did not make a higher high, but gold did. So during the second phase of the commodity bull, this is where gold took over. It's reversed this time. Now, if you remember the chart of oil, you can see oil is really depressed, and the bull market here is just now beginning. We've only just recovered this last 3-year cycle low here. We're starting to break through some major resistance zones, but we haven't gotten back above the 200-week moving average in energy. So energy is lagging. Energy, base metals, agriculture, I think, will lead along with gold. But the leading sector during the first phase of this commodity bull is going to be gold. So back to the gold chart. All right, so you can see while the rest of the commodity markets are still pretty depressed, gold has already broken out to new highs. So the precious metals are leading. It's an indication that to some extent, this commodity bull is going to be driven by currency debasement, whereas the last bull market, at least the first phase, was driven by demand. As emerging markets started to expand, there was a huge demand for basic materials and energy. And then as we started QE, then the second phase of the commodity bull was led by precious metals. Well, this commodity bull is going to be driven, at least the first phase is going to be driven by currency debasements, and you can see gold is already leading this bull market. All right, so while I've got the long-term chart here real quick, you can see we've got a couple of important levels. I mentioned as we were in this correction that I thought Well, first off, this breakout came way too late in the intermediate cycle. I knew it wasn't going to be sustained, and it wasn't. We broke down. We broke back below this 19, I think it was 23. Said that was going to happen. I also said we would probably come down and test this major support zone right here at about 1800, and that we would probably have to break below that. That would give, it would panic the retail traders, the hedge funds, allow the smart money banks to get into positions on what looked like in real time as a break of another major support zone. And then that only lasted 2 days, and then we turned back up. So pretty confident this is a final intermediate bottom. We're now on the verge of trying to break back above this resistance zone here at 1923. This breakout will be sustained. So now let me go down to a shorter term view, the daily level. All right, now the T1 pattern is definitely still in play. The parameters, the first leg up, kind of established the magnitude. Then we get this sideways churn, and then the second leg up is usually about the same magnitude as the first leg. Although the second leg usually comes up a little bit short, and that's exactly what happened here. We had about 350 points, give or take a few, for this first leg, and then we had about 300, almost 300 points for the second leg. And then the last part of the pattern is a retest of the consolidation zone. That's what we have done here. We've come back down to retest the upper part of this consolidation zone, and I'm pretty sure this is an intermediate bottom. We got our characteristic bloodbath phase here when we broke this support at 1850, and on on Thursday, despite some major attacks on the mining sector to keep price suppressed, I think the banks wanted to try very hard to close gold below 1900 for year end, but they were unsuccessful, and gold has closed above this intermediate trend line. I pointed out the attacks here at the trend line to try and keep gold suppressed. I knew they weren't going to be able to continue to hold it down indefinitely, and they've lost the battle on Thursday at the close. That doesn't mean they can't push it back below there early next week, but closing above this, even if it doesn't hold on the first attempt, is a pretty solid indication that this is an intermediate bottom, and we're in the advancing phase of a new intermediate cycle. This is the first daily cycle. Surprises can tend to come to the upside during a first daily cycle, and very often they can retest the previous intermediate high before that first daily cycle tops. So you want to be careful trying to trade in and out of this first daily cycle, because very often a surprise will come to the upside. If you think you're going to be able to dodge a corrective move, and you get on the sidelines, and then all of a sudden you, like right here, this looked like maybe price was going to come back down and drop back below that 200-day moving average. If you got out thinking you were going to dodge a bullet, then you missed this run up to tag this trend line here. So you got to be careful during the advancing phase of a first daily cycle. It's best just to close your eyes and hang on so you don't get caught out of the market when a surprise to the upside comes. One could even make the case that we've got kind of a little triangle pennant pattern that has a continuation pattern that has formed here, and gold's trying to break out of that now. So we'll have to see where we're at next week, but I'm pretty confident. I'm very confident that this is a final intermediate cycle low. We tested the T1 consolidation zone, and now we're in the advancing phase of a new intermediate cycle. We're only on we'll be on week 4 next week. They tend to, or in a bull market, intermediate cycles right translate. So this should still have at least 10 to 15 more weeks to rally before topping. It should break out above this, make new all-time highs. I tentatively have a target somewhere between 23 and 2500, and maybe a low possibility target of 3000, although I think that's probably too much to expect this early in the bull market, and this bull market should still have at least 5 to 6 years to run, if not longer.